Hi everyone, so an excellent way of evaluating the likely effectiveness of monetary policy is to consider the scenario of a liquidity trap. Okay, now a liquidity trap occurs when interest rates are so low that they cannot be cut any further. And so therefore, if you do actually decide to increase the money supply via quantitative easing, it's unlikely to actually have any impact on interest rates. Since the global financial crisis in 2008, in the UK, US, Eurozone economies, we've seen interest rates go as low as 0.25%, which is in fact, when you consider the effect of inflation, a negative real interest rate. Okay, at such levels, of course, consumers and households and businesses have no incentive to actually save that money because the returns are so poor. So instead, it's argued under a liquidity trap that businesses may choose to actually hoard cash and not use it productively to actually undertake investment, even though interest rates are so low. They do this because expectations about the economy and future state of the economy are so poor. Okay, so here any attempt to improve lending conditions through quantitative easing perhaps will have no effect as investors wait for expectations about the economy to actually improve. Okay, so let's just consider our liquidity preference schedule here, which, as we saw in our last lesson, is downward sloping. Okay, now we would normally, of course, expect our money supply to be perfectly inelastic, and we see the actual rate of interest there at R1 and money supply 1 there, okay? So we can see the quantity of money in the economy. Okay, now during a liquidity trap, this is where, as it says here, interest rates are so low that they cannot be cut any further. So what we're really talking about is a very low level of interest rates, and at that level, the demand for money becomes perfectly elastic. Okay, so the demand for money becomes perfectly elastic because people will continue to actually hoard cash. Economic agents will hoard cash as opposed to actually go out and want to actually spend that money on consumption or investment in the case of businesses. And therefore, we can see that R2, yes, we have had an initial reduction in interest rates, but any further attempts by the monetary authorities to reduce interest rates fails to actually achieve such an outcome. Okay, now this will lead to, of course, very low levels of investment in the economy. Now, yes, some firms may take advantage of the lower cost of borrowing, but the types of investment they may undertake may be share buybacks, where they actually use debt to actually buy back shares in their business so that they retain more ownership of that company. Alternatively, companies may be undertaking mergers or acquisitions, so taking over other companies and using debt to finance such acquisitions. Both of those types of investment are likely to be quite good for the stock market, but are unlikely to actually have a dramatic impact on the actual level of consumption in the real economy. Okay, so we can see at R2, MS3, we're going to have a very low level of economic output being attained in the economy overall. Aggregate demand, consumption, investment is all likely to be very low. Okay, there's 5 key signs when it comes to a liquidity trap. The first being that there's likely to be very low business investment being undertaken. There's likely to be a low level of job creation, low inflation, as well as a low velocity of money, so people hoarding cash as opposed to actually spending it readily. Okay, there's also likely to be low bank lending. Okay, so what can be done in such a scenario? Because we're really talking about a depression rather than simply a recession here. Expectations about the economy is so poor, the monetary policy is failing to actually really stimulate the economy. Okay, so the potential solutions most commonly cited is expansionary fiscal policy. So shifting aggregate demand, increasing aggregate demand by increasing fiscal expenditure, government expenditure. Okay, so that's the first means. Secondly, it could be about raising interest rates This is slightly contrary to what we typically understand, but of course when it comes to raising interest rates, if we think about what that may mean, of course it may mean that consumers are actually now increasing their income as a result of their savings actually earning some sort of return. So that can be effective. Okay, and thirdly, global policy coordination as well. So the fact that you do have some nations which save very, very large amounts of cash because of sustained and persistent current account surpluses, the likes of China and Japan, Germany, run those enormous current account surpluses, where they could take their excess savings and actually invest in countries that are suffering from a liquidity trap. If we just think about some of the consequences of this on these 5 signs, so then with that third point, business investment would increase, job creation is likely to increase, and that would obviously help stimulate aggregate demand, as would our fiscal policy, and that would generate some inflation in the economy. It would also help increase the velocity of money. And if the banks are being recapitalised, perhaps because interest rates are higher and people have actually got an incentive to deposit money into bank accounts, into bank savings accounts, then bank lending may actually pick up. Okay, and those expectations about the economy may improve. Okay guys, thanks ever so much for joining me. I hope that's been useful. Don't forget to subscribe there, okay, and hit that like button. Thanks guys.